right, so we started off FOMC week with a little bit of a positive day today, thanks to some of the stocks in the Qs, the NASDAQ 100 are rallying. But not everything got the memo, especially the small cap index. Small cap index still hampered by that big three-headed monster that we talk about all the time. And it happened to be the culprit again today for a lot of the risk aversion. Well, the minimal amount. It wasn't a huge sell-off. But it was a pretty, the Qs are pretty much an outlier to the upside. Everything else on the risk appetite scale struggled to a degree. So we'll break down, how things are looking. How things are looking specifically the Russell. The Russell 2000s, the index, the Dow too had been, but now it's more the Russell is the index that's really inching more and more towards that intermediate decline. We're still kind of in that stage, and all the indexes in between. The end of a rally and the beginning of an intermediate consolidation, right? An intermediate decline. But we're kind of in that stage where we're just kind of in convergence with most of the index. But the Russell is now kind of tipping the scales more over into the decline stage. So I'm going to break down the patterns that we're seeing there, how it's looking, what the expectations are based off of that, what's driving a lot of this action, including in the sector rotation. There's clear sector rotation going on right now. And as you see, as I'll show you from a breadth standpoint, not exactly the best sector rotation. And then our trade idea is a stock that's in this technology area that really broke down hard. So we'll talk about how to trade that trend-changing move that we saw in that stock today. So let's go ahead and get started. Today is Monday, March the 18th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So I appreciate those who do like this day in and day out. We're in the 60s still, or again, the goal is always to get to 100. Those who do, again, thank you to those who do like this. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started with looking at the S&P 500 with the market forecast indicator. As you can see, again, a rally today up 2/3% roughly. Intermediate line, again, still in the upper reversal zone, has been now for weeks and weeks and weeks. Really, pretty much the whole entire year, except for the very first few days. The intermediate line dipped its toe under and then jumped right back up above it here. The market sentiment line's been in the upper reversal zone for the entire year. Again, almost, say, for the first few days. The intermediate line's been above market sentiment for most of this time. There's been a few periods of time where it was like briefly below it there, and like a day below it here. But for the most part, we've just been grinding up to the upside. And every time we get a dip, the near-term line into the bearish territory, we bounce right back out of it. And as of right now, that appears to be the case again. Again, the near-term line's not out yet, but that usually takes another day to follow the momentum line. And we would like to see that momentum line jump further into the upper reversal zone, so that, again, it doesn't guarantee the near-term line will get there, but it doesn't have to get there for the near-term line to be in the reversal zone. But it would be nice if the momentum line can get above the 80th percentile, and then there's a good chance the near-term line follows suit. And the higher the near-term momentum line goes, hopefully we can get the near-term line to stay up there for a while. That's kind of the idea. So far, it's only a day, right? It's only one day this week, but so far we're not quite there yet, and we are back below this 2.5% mark up above. When you're above that 2.5% mark, we're doing really good. You can see some other instances here, but when you're below that 2.5% mark, now we start to converge, right? We did it over here. We start to converge onto that moving average, with the increasing the likelihood that we break through that moving average. So we would like to stay above it so we can continue the trend as much as we can. Let's take a look at some of the other major indexes. The NASDAQ 100, its intermediate line is actually still falling. We did get that bull tag on Friday. We bounced off of it so far. So far so good there. We're less than 0.5% above the moving average. And the intermediate line still in bullish territory, so that's a good sign. And it's still below market sentiment, which is not quite the best. But we'll see. The short-term sentiment is improved. Has improved enough, but we're, again, at least it's in the right direction. Looking at the Dow Jones Industrial Average, you can see again that bull tag on Friday. We didn't quite get as much of a bounce today, only 0.2%. The near-term line actually fell further into bearish territory, but at least has not gotten to the reversal zone. The momentum line, which was oversold, did bounce up, but still in bearish territory. So not quite the bounce yet that we want to see. I'd like to see some follow-through on this tomorrow. The Russell 2000 is a little different story. So it got a bull tag today. So it didn't get the bull tag yesterday like the NASDAQ and the Dow did. And the S&P still hasn't got one either. But the Russell got a bull tag today. So here we go, right? So again, is this a bull tag that we're going to bounce off of? Or is this a bull tag that will start the new intermediate decline to the downside? The market sentiment, or the intermediate line, has crossed slightly below market sentiment. You're looking over there on the left, market sentiment at 64.47. The intermediate line is 64.30. So that's how much we've dropped below it. Short-term sentiment, as you can see down here, is still pretty bearish. Near-term line, though, is not in the reversal zone and may be doing a little bit of a bullish divergence, right? The higher lows with lower lows here. So that, there's a good sign that we might be able to bounce right off of this bull tag, right? That's the idea. Like you get this bull tag. Ideally, you want to bounce right off of it to avoid any dark pink shading in a red line, and just kind of bounce up and get going to the upside. So we're not quite there yet, but we can get there pretty quick. Again, my expectation is we do bounce up another day or two this week here tomorrow, potentially Wednesday. And then the question will be how much. I don't think we'll bounce up very much. But I do think we'll continue with, a bullish bias going into the FOMC meeting. Then after that, obviously, it's a big wild card. Let's take a look at the long-term weekly chart. And now we're getting a higher close again, so that's a good sign. It's still a lower high point, and now you can see we're back into that upper decile with the green dot there. So that's a big gap between the 10 and 40 week moving averages. That's what this is measuring, and this is the again on the past 3 years what decile we're in. You can see the size of the bullish candles continue to converge down to zero. So we're losing momentum. Needless to say, I think it's pretty obvious, but we're losing momentum here. And again, you look at the Russell 2000, which is a little different story than what we're seeing. And we got that transition candle last week, and now we're starting off with a bearish candle. So the Heikin-Ashi differential is actually crossed below zero again, just like it did over here. So it's since October, when everything's been bullish, the S&P hasn't had a bearish candle, and the Russell's had two transitions into bearishness. This one, and then so far now this one. Again, as long as they're weak bearish candles, we can bounce right off of those. As when they get bigger, then that's what signals the potential of a new trend. So far, it's weak enough that we can bounce off of this to the downside. Looking at the 3 green arrow chart, obviously you do not have 3 green arrows. You don't have the 3 reds anymore in the Qs. You do still have the 3 reds on the diamonds, and you do now have 3 reds on the Russell. So again, 1 or 2 days is okay, but we need to get back to where we don't have 3 reds anymore. And so right now we're still converging on the S&P where there's no shading at all. We got 3 red arrows here. Let's see if this turns into something more. I mean, there's some pretty decent negative momentum on these major indexes. Let's see if that actually turns into something more here. When you look at the 2 line versions of this, we're back above the 8-day moving average on the SPY, but not on IWM, right? IWM, you had broken below the 17 2 days ago, stayed below it on Thursday and then Friday, and then now we're still below. We're still in the gap between the 17 and the 30. We haven't broken that yet, but once you do, obviously you would break that 30. You start looking at that 50 holding, or you just break all the way down to the 200, and that's obviously a very real possibility now. as you can see, look at that big convergence, and we've just been gradually moving towards zero on the diamonds, and the Qs have been doing something very similar, right? Very significant divergence here, as the stochastics is in the lower, is in bearish territory now on the Qs, which is a new development. And then the diamonds, you can see stochastics is still in the upper half. So that's a pretty decent development here on the Qs. Now that we are moving into that bottom, to bearish territory there. Let's look at some of the other oscillators, like the DMI for the S&P 500. If you look at the DMI, again, a bounce back up. We are post-expiration now. The DMI, like the positive indicator, jumped back above 35. The negative indicator dropped back below 25. So again, positive development, not enough of a gap there to keep the ADX from dropping. So it is dropping a little bit. Of course, when you look at the other large cap indexes, there's no trend right now in the diamonds. They're both below 25, and the positive is below the negative. And the Qs, again, they're both, they're between 25 and 30, and your ADX is way down below 20. Remember, the Russell 2000 actually shows a change in trend. Like your negative is just slightly above the positive. They're both above 25, but they're slightly above, and so you can see the working, like you can definitely see the signs of weakness developing that we've been talking about for like the past week and a half or so. Looking at the RSI and the CCI, still very strongly bullish on the S&P 500. The NASDAQ is not as strongly bullish. Had gotten below minus 100 down there, though we bounced up. So far, so good there. The Russell 2000 also is not so strongly bullish. We have not bounced back up above the minus 100 level, and we are below 50. So it's not bearish, but you can see it's not nearly as bullish as what we've seen, and we're starting, again, signs of weakness developing there. Looking at the Ichimoku cloud, you can see the very strong trend still for pretty much everything. Still has a very strong trend. The diamonds do too. The Qs had reestablished a pretty strong trend, and then IWM is the one the trend is weakening. It's still there. It's still weak. It's still a trend, albeit weak. We still have a positive rate of change. You're pretty much on. You're above the cloud. You're pretty much on the blue line, but we haven't broken it yet. So we haven't dropped to zero quite yet. So this is probably the closest that is on the verge of losing the trend that it's on. And when you look at the Bollinger Bands, you also see, for example, SPY still in the upper half of the bandwidth, not in the upper quartile, but in the upper half below the Keltner channels. Again, that's not the same for the Qs. The Qs, which had dropped into the lower half, is barely back above the upper half of the band of the 20-day average there. If you look at it on its chart here, you can see we did dip below the chart's midpoint yesterday or Friday. We dipped back above it and barely above the 60th percentile, still below that moving average there. The Russell 2000, on the other hand, is clearly in bearish territory, clearly below the lower half of the 4-week range, clearly in bearish territory when you look at the stochastics. And then when you look at its Bollinger Bands and Keltner channels, you can see things aren't looking so good there either. You are in the lower half of the bandwidth, not the lowest quartile yet, so that's still okay. The bandwidth is still inside the Keltner channels, but you can see the momentum is shrinking as the bands look like they're on the verge of getting back out of the Keltner channels, but this time with a downside move. So that's, again, this one appears to be more on the verge of something of a trend change than what we're seeing on the S&P, but even like the Qs in the Dow look closer than what the S&P. So it does look like we are definitely moving slowly in that direction there. Looking at this week's range, you can see we do have a higher high and a higher low. We are so we did close up. We gapped up. Started to fill in the gap by the end of the day. Still have more to fill in by the end of the day, we still have more to fill in. So look for that sooner rather than later to fill in the rest of that gap. We did fill in the rest of Friday's gap with this morning's move, the gap to the downside. You can see this week's range clearly in the upper half of the chart. We haven't had a new 4-week high point, so we are now below 70 on the green line. That sets us up for a break to the upside. This low point is going to be there for just a couple more days, and then our low point is going to jump up. It's going to jump up to here, and then it's going to jump up to somewhere around here, right? So unless we get a new high point, or for that matter, a new low in the next, 3 or 4 days, we're going to get a very, very, very tight range with the green line having dropped below 70. So again, setting us up for a squeeze play in the wrong direction, unfortunately. IWM has already had that. Its 4-week high has also dropped below 70, but we are in the lower half of the chart. Remember, we're in the lower half of the chart. We're below the 4-week point of control. We did stay inside the range of yesterday at the lower end of last week's range. And that's how close we are to breaking through last week's low point. So again, a lot more dangerous on the IWM than what we're seeing right now on the broader market index. Today's range and volume, again, above average in the volume. And when you look at the close here, 509.83 with the low 512.44. So you're looking at not quite 4 points. 3 points, excuse me. It's about 2.5 points maybe added on to that. So you are above the average on when you count the overnight trading. You also are above the average on the volume. So we're picking up volume. We're picking up range. Though again, it's we got to incorporate. It does look at those highs and lows. The ATR does. So we are again we're inching closer to that 1% mark, which is the dividing line between a intermediate pullback or not, right, now that we are below it. Volume also picking up. Again, doesn't pick up during bullish moves usually. It can, right? You can see over here, picked up during a bullish move, and ultimately really picked up during the weakness at the beginning of the year. But typically, it picks up during bearish moves, especially when there's a pickup in the range to go along with it. So again, you can kind of see things starting to look in the wrong direction here. IWM still has volume and ranges declining, so they haven't really started to pick up yet either. So that's one positive development in these weaknesses that we're seeing in the small cap index. When you look at the VIX, remember the VIX has been up relatively. It's been up. It's still below 15, dropped here, still below 90%. The VVIX really dropped back down below 90. As a result, the VIX really has not followed the VVIX up as much, and so you're getting another drop in the correlation back below 50%. Again, typically, when these jump back up to where they're highly correlated again, and a lot of times can happen, you get a bullish move out of it when it comes back up, a bullish move out of it when it comes back up. And so we'll see if we end up getting a bullish move out of this when it does come back up. But it's, again, not the best sign that the correlation has gone back down to very weak positive correlation when it's traditionally very strongly positively correlated. Again, suggests that there is a move, there's an impending move higher on the VIX as we are squeezing in between these average values of the VIX here. So we're kind of squeezing towards a pop one way or the other. And it can pop to the downside. This pop would be much more limited than any pop it would have, even just up to 20 up to the upside. All right, now let's take a look at what's driving the price action here today, and we'll start off with 3-month chart like we always do with different asset classes. You can see the big drop in bonds, which would mean a rise in yields. That's a pretty considerable rise in yields over the past 3 months, though the dollar's not been bullish over the past 3 months. It's actually been down pretty significantly. Commodities have also been down. So only one of the three headed monsters. But if you look at here lately, it's a different story. One day in particular last week when they were all three reared their ugly heads. Then you look at here what's going on today, and commodities were the big winner today. Bond yields were higher too, and the dollar was up. So all three things up again today. The Qs were able to withstand it. IWM, of course, was not. And so, and again, we talked about this on Friday in Friday's video that we're slowly starting to trend up on these indicators. The dollar's back above its 50-day, back above the 17. The MACD above its moving average. The 10-year yield made a run up here today. It's flirting with getting up to new highs itself. MACD and stochastics are positive, up to 4.34%. Commodities, we had made that big breakout move last week, continuing today above the point of control. Strong MACD, stronger MACD that we've seen in a while here. So we've had a few of these runs. It's making another one. It's making another one of those runs right now. And again, looking at the weekly versions for this, you can see we had just barely gotten above the 17-week last week on commodities. So just, are we just getting started on the run for commodities? Yields, again, you can see we had just gotten back above these moving averages after being below them. Now back above the 30-week moving average for yields. Are we just getting started on a move higher there? And then the dollar index, again, MACD is positive, stochastics is up, and you're just getting back above. After a 1 week drop below, you're getting back above the 17 weeks. So it's not like we're overbought in these things. It appears that these trends are just kind of getting going here. Here's the market forecast for the dollar, and it's not quite dark green shading the green line, but the intermediate line has turned back up. Short-term sentiment was strong enough to get up here into the upper reversal zone to establish a new intermediate run to the upside. The 10-year yield, you can see, has dark green shading a green line, intermediate line back into the reversal zone there. And then commodities, which have been basing here, really breaking out with a dark green shading green line high above the moving average, as high as we've seen for a while, in the 80th percentile right now, and just starting to really get going here. I mean, looking at the weekly version of this, remember, we're just starting here. We have actually dark pink shading in a red line, but that near-term line, again, is the most bullish it's been during this decline, right? It's, it doesn't guarantee anything. We had, bearish, a near-term line that got up here. We couldn't get above the 30-week moving average, either one of these two instances. So, now let's see if it will this time, and if it does, get above its market sentiment and follow through on this. Now we have something, there's, that's going to lead to higher yields and higher inflation expectations, especially if the biggest reason for it is this move in crude oil, which, again, this intermediate line is above market sentiment. It is rising above the moving average, and now is at least light green shading and a green line with highs up above all these recent highs. Looking at the sector rotation here, you can see, let's look at the 12 grid for the different sectors. The S&P is up here in the top left corner. You can see XLK got that bull tag, XLY got the bull tag as well, XLC was close to one, and they're all right around moving averages. Energy materials still very strongly bullish despite some of the strength in the dollar. Real estate also got a little bit of a bull tag. It's been acting very similar to these three. It's like another one. Staples and utilities have dark green shading and a green line. Industrials and financials do as well. Healthcare also kind of acting in conjunction. In fact, when you look at the rotation here, you can see right now the sectors that are in the leading quadrant remain to be energy materials, real estate, utilities, so your interest rate sensitive, dollar sensitive areas. Again, interest rates are rising and the dollar is rising, but that hasn't put any pressure on these four sectors. They usually would, but it hasn't yet. Financials doing okay as well. Staples has now entered into the leading quadrant. So now you have pretty much, except for healthcare, all the safety trades there. You have now technology has dropped into the lagging sector after being the improving. So now you have technology and discretionary in the lagging. Communication service has improved into the improving, but again, it's got a long ways to go. Technology couldn't go there, right? Technology, you can see, came out and got into the improving, but turned back down before getting into green. So again, I would expect if technology and discretionary are still down here, that will be the same outcome that we'll see with XLC as well. But again, you can see the strength that we've had in some of these sectors. Materials over the past 2 weeks, energy over the past 2 weeks, kind of just getting very strong. Utilities has moved in over the past 2 weeks. Staples now has moved in. Real estate is losing because it's, again, very similar to technology and those areas, these other cyclical areas. And then, of course, like financials, which had lost some momentum, has gained a little bit, but not very much, and is just kind of languishing here with some decent relative strength, but not very much, and not very much momentum either. When you look at today's breadth, something we always like to look at as well, just to kind of see whether or not we're as bullish, right? Because we're talking about this rotation. A lot of people are talking about this great rotation. The breadth still is pretty negative. We're not, we've had a third straight day of negative numbers there. The money flow had been getting more negative too. You can see the money flow has still, it jumped back up above 60, so it's still in bullish territory, but it definitely is off of its highs there. When you look at the number of stocks above like this, well, first of all, look at the skew. You can see the skew dropped big today, way below its moving average. Again, when it's dropping and the moving average is dropping, that's usually not bullish. It has been here, but you notice there's been clear rotation. There's definitely clear rotation. And then when you look at like, the dark pool index and how much buying there's going on in the dark pool, I mean, look at some of this. I mean, we are significantly lower. It hasn't been updated yet for today. Let's see if let's refresh the page. Yeah, so it hasn't been updated yet for today, but you can see how as we've been grinding up higher, the trend of the dark pool buying has been getting lower and lower. And over here just a few days ago, last week, was one of the lowest amounts of pool buying that we've seen in a long time. So when we were at a low point, and you can see it's not only that too, but you can also see that the amount of retail buying has also been dropping off like a rock. So instead of going up to higher highs like it generally does when you're moving higher, in fact I tweeted this, that you generally get the highs and lows of the gamma exposure index here off this squeeze metric site with the highs and lows on the S&P. We got a low here on the gamma exposure with the low on the S&P. But now, here we just barely got a high a few days ago, nowhere near the high of the gamma exposure index. So you can see it's definitely been the breadth has definitely been tapering off, to say the least, here. And you see that in the new highs and new lows being below their moving average and back below 100 at 84 there. That not fully updated yet. The number of stocks above the 50-day moving average is off their highs. They had gotten above 400 again. Still at least above its moving average, so that's still one positive sign there. And the 200-day is also still above its rising moving average. The ratio is not quite back above its moving average, but again, getting above 1 and above a moving average is not bullish either. So breadth is not looking as great as we think it is. You look at the S&P relative to the equal weighted index, and it's up pretty strong, and generally that's positive for the markets. Looking at the Qs relative to IWM, remember IWM was down today. It's also back above its moving average. Again, has a positive correlation generally, and we'll see how much longer we can get. The long-term momentum has been declining, and we're at we did jump up above 100 here. Is this the peak? Now are we going to get some more weakness like we did on Friday in the Qs after that last bounce? We're going to get a similar drop on Friday. We'll see if we follow that pattern or not going into a new day tomorrow. All right, so that brings us to our trade idea of the day. Let's take a look at, let's pull up the market forecast, and let's take a look at Roblox. Roblox had a pretty down day today. Got a cluster, got an oversold cluster. We were already kind of flirting. We had some dark pink shading and red line moments, but we were flirting with it last week, potentially getting back above. But unfortunately, we formed a bearish near-term peak, and then came back down, and then we just really broke down today. Broke support in a big way today. Lots of breaking through lots of lows, and got an oversold cluster. Big down day, down 12% below the moving average. When you look at the long-term chart, we closed below the so far, right? It's only one day into the week, but so far we're closing clearly below the 40-week exponential moving average or 200-day. Similar, it's a proxy that we use here for the 200-day for a weekly. Big bearish candle, the biggest one that we've seen in a while, right? That can be the size of a candle that leads to a new bearish run to the downside. Obviously, you have 3 red arrows, pretty decent amount of volume as well. More than 1.5 times when you look at it down here, more than 1.5 times. You also, another big break today was below that 200 days. So not only the 40-week exponential, but the 200-day simple. We dropped below. MACD is negative. Stochastics dropped back below its moving average and back into bearish territory. you're below the point of control clearly now, and you're flirting with dropping out of the value area, where again the value area is 70% of the volume. So most of the rate of the trading is up here in this between these purple lines. The other 30% is outside of them, so just a smidgen up here. That was back over there, and then the rest all down here. So we're looking to move out of the value area. It's a pretty significant breakout when that happens. There's also multiple breakout patterns, there's also multiple breakout patterns over on some of these oscillators as well. And we'll take a look at the DMI first. And you see breaking above 30, not quite below 25 yet on the negative indicator, but you are breaking up above 30 on the positive indicator. I don't know why that's not, oh, there we go. So there we go, back above 30 there, and almost breaking below 20, but a pretty breakout pattern, pretty decent breakout pattern there. When you look at the RSI and the CCI, big breakdown, below 40, below 200. The weekly CCI broke below -100. So that's a big significant breakdown there. Again, potentially starting a bearish trend. And then looking at your Bollinger Band, or let's look at the Ichimoku cloud. We didn't look at the cloud here. Roadblocks. So well below the cloud, very significant bearish rate of change. You just went straight up to intermediate trend strength above 65, below -2. And then now looking at the Bollinger Bands, you can see we busted way outside of both the bands, Bollinger Bands and the Keltner channels. So big breakdown that can lead to something more, right? So that's the expectation on that. So what I decided to do is come over here to the options chain and then do I was looking at actually doing a little bit longer term put, but doing a long put vertical instead to try to keep the cost down. But I found that when I went pretty aggressive down here on the long put vertical spread from May, that I had pretty similar reward to risk ratios for April, and I had more flexibility in terms of timing for April. So when I sell the 33, which is the low 20s on the delta, and buy the 35, so buy 2 strikes away, I have a little bit of flexibility there. Whereas, and let's see here, let me get rid of the, there we go. So there's the trade that went through. So a little bit better than 2 to 1, but you see that how much move I have. When I was looking at similar options in May, the maximum gain was right on the edge of 1 standard deviation, and I was still getting about a 2 to 1. So it wasn't quite the setup I liked to see. And if I can get the same setup with a little bit more flexibility for timing and earlier, because remember on long vertical spreads I have to wait all the way to expiration date. So if I can get it earlier instead of having to wait till May expiration, now I can get out of this at April with hopefully a 2 to 1, a reward that's twice the risk, then we'll take it. So that's kind of the idea behind the setup and picking in this case, it's expiration month that we ended up picking. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.